You've noticed it. Everyone has. Oil spikes on a Monday, and by Friday, the gas station sign has already jumped. But when oil falls, that same sign descends like it's afraid of heights. A penny here, a penny there, weeks of nothing. You're not imagining it. Economists confirmed it decades ago, measured it in dozens of countries, and gave it a perfect name. Rockets and feathers. Prices rocket up. Prices feather down. And it's happening to you at scale, right now, in the middle of an oil crisis. This is the story of why the pump is fast in one direction and slow in the other, and who pockets the difference. Spoiler: it involves your own brain. First, let's establish this isn't just driver paranoia. In 1991, economist Robert Bacon studied British petrol stations and found prices adjusted upward faster than downward. He coined the phrase, rockets and feathers. 6 years later, Borenstein, Cameron, and Gilbert ran the numbers on American gasoline in one of the most cited energy papers ever written. Same verdict. Pump prices absorb a crude increase far faster than a crude decrease. Since then, the pattern has been found across the US, Europe, South Korea, Brazil, branded stations, unbranded stations, almost everywhere economists point the instruments. The asymmetry is real, it's measured, and it's stubborn. The interesting question is why. There are 3 suspects, and you're one of them. Suspect 1. The gas station itself. And here's the twist. The station is mostly innocent on the way up. Stations live on margins of cents per gallon. When crude spikes, their next wholesale delivery costs more immediately, so they raise the sign fast just to avoid selling at a loss. On the way up, competition and furious customers squeeze station margins to the bone. The rocket phase is often the station's worst week. Then crude falls. The wholesale price drops. And now the station faces a delicious choice: cut the sign immediately, or drift down slowly and finally rebuild that crushed margin. The feather phase is payback time. Stations don't profit from the rocket. They profit from the feather. Suspect 2. Specifically, your selective outrage. When prices are rising, you turn into a detective. You compare stations, you drive the extra block, you download the app. Every seller knows they're being watched. But when prices are falling, you relax. The sign says lower than last week. Good enough. You stop shopping around. Economists call this search theory. Sellers cut prices only as fast as customers force them to. Rising prices create vigilant customers. Falling prices create relieved ones. The feather exists because nobody chases it. Your relief is, quite literally, their margin. Suspect 3 is the sneakiest, the old price itself. Gas stations on the same road can't legally agree on prices, but they all stare at the same number, yesterday's price. When costs fall, the old sign becomes a silent meeting point. Nobody cuts first because cutting first starts a price war that helps no one. Borenstein's team called it focal point pricing, coordination without a single phone call. When costs rise, the focal point shatters instantly. Everyone must move or lose money. When costs fall, the focal point holds. Gravity for prices, but only in one direction. It's not a conspiracy. It's worse. It's an equilibrium. Now, the excuse you'll hear at the counter: we're still selling the expensive tank we bought last week. It's partly true. Stations do buy fuel in batches, and the tank in the ground really was priced days ago. But here's the test that breaks the alibi. If old inventory set the price, the sign would also rise slowly when crude spikes. You'd be burning the cheap old tank first. It doesn't. The sign jumps the same afternoon. The old tank only seems to matter in one direction. Inventory is a real cost and a one-way excuse. Remember the rule: Every explanation that only works downhill is a margin wearing a costume. For the cleanest receipts, rewind to 2022. That June, the U.S. average pump price crossed $5 a gallon for the first time in history. Then crude crashed, down roughly 30% by late summer. And the pump? It strolled down a few cents a week for months. It got so slow that the President of the United States publicly told gas stations, quote, "Bring down the price you are charging at the pump." On social media, at an industry, the industry called it market dynamics. Economists just pointed at the 1991 paper. The feather doesn't care who's president. So, can anything speed the feather up? Yes, and it's been measured. Transparency. In markets where governments publish every station's price in real time and apps shove the cheapest pump in your face, the asymmetry shrinks. Studies of South Korea's disclosure system and Europe's price reporting rules both found the feather falling faster. The mechanism is exactly what you'd expect. Transparency does your searching for you. The lazy customer discount disappears when the app is the customer. It's a rare, tidy economics result. The fix for an information problem is information. The rocket can't be stopped. The feather can absolutely be hurried. Now watch the textbook play out in real time. March, the Strait of Hormuz closes. Energy prices leap nearly 11% in a single month. The rocket, on schedule, at every pump in America within days. June, crude cools back from its peak. Brent even touched $93. And the pump? Drifting. Slowly. A few cents at a time. The feather, also exactly on schedule. That small drift was still enough to bounce consumer sentiment 9% off its record low. That's how starved drivers were for relief, and how slowly relief travels. Inflation is running at 4.2%, and energy is doing most of the pushing. Which makes the feather a national economic event, measured in your weekly fill-up. Once you can see rockets and feathers, you can't switch it off. Because gasoline is not the only price that plays this game. It's just the one with a giant glowing sign out front. Take your credit card. When the central bank raises rates, your interest charge jumps onto the very next statement. When rates are cut, that number drifts back down for months, if at all. It's the same with loans. The day borrowing costs are supposed to rise, the rate leaps. The day they're supposed to fall, it limps lower, one reluctant step at a time. Or airline fuel surcharges. Bolted onto your ticket the week oil spikes. And then very quietly forgotten, long after oil has come back down. Even the supermarket. A cost shock lifts the shelf price fast. When the shock passes, the price strolls back down if it ever quite gets around to it. The pattern never changes. Costs that rise reach you at the speed of a rocket. Costs that fall reach you at the speed of a feather. Once you know it, you'll see it everywhere. So, rockets and feathers. The station squeezed on the way up and healing on the way down. Your vigilance switching off at exactly the wrong moment. And yesterday's price, quietly coordinating everyone. You can't repeal the pattern, but you can stop subsidizing it. Shop for gas hardest when prices are falling. That's when the spread between stations is widest and when nobody else is looking. The rocket takes your money loudly. The feather takes it quietly. Now you can hear both.